Greetings, options traders. This video is called Double Calendar, Adjust or Exit. And what I want to do in this video is to show you a trade that is on already, and to look at it. It's at a close to a crucial junction point here where something needs to be done. Possibly something needs to be done, and I want to go through the two or three different options that are there, so you can see, once you're already in the trade, it makes sense that you understand how to handle the trade once you're already in. Anybody can get into a trade like a calendar, but you have to make the right decisions once you're in the trade to get out or to get in or to adjust or how to play with it. So that is the topic, and let's go ahead and get into it. This trade that you see on the screen is a double calendar in BRKB, which is Berkshire Hathaway B shares. Today's date is 4/9/2012. Now you can see that right here where I'm moving the cursor, 4/9/2012. Expiration date is 4/21/2012, so we have roughly about 2 weeks. Today's a Monday. These are expire on Friday, not this week, but next week. So we got about, including today, you got about 10 trading days. So let's take a look at what we got here. So now this is a double calendar. Now originally, the trade was put on as a single calendar at the 80 strike. So basically the trade looked like this originally, and then Berkshire Hathaway, it moved up towards the break-even, got to the break-even, and what we did was we added a 82.5 strike calendar, and so our break-even was adjusted. Now since then, let's go and take a look at the chart. Once we added the second calendar, Berkshire Hathaway then decided to go down. Actually, this is let's put the right stuff on there, the right line, so you can see exactly. Okay. So yeah. So right around here, this 81, 82 level was where the original break-even was. Berkshire decided to hit it, go a little bit above it, so that we added a second one. And as you can see, once it went up, then since then it has, it got to the top, and then since then it just has continued to fall down back to where it was when we got in, which was somewhere around here, I believe. So if we had not done the adjustment, we would have been sitting very nicely right here. But since we did do the adjustment, we are sitting with what we have, which is right here, which is this. So no big deal. Okay, and now this is what we have here. So now the question is, you got about 2 weeks to get out to expiration. Now we don't want to stay in to expiration, and I don't normally like to stay in to the week of expiration. I like to get out this week. The later you can stay in, the better, because the more time decay you have, but also the riskier it gets, because the Greeks, they start going crazy the last week, especially of expiration. The closer you get to expiration, the closer, the more the Greeks go nuts. So what we need to do is really decide is, are we going to adjust this trade, or are we going to exit this trade, or are we going to do something else? Basically do nothing. So we got three options. Now why am I saying that we need to adjust? Basically, right now we're right around 80. The stock is trading at $80.03. You can see that. And we've been in this trade for several days now. Almost about a month, almost 30 days. And we got a decent sized profit. We got, right now it's showing $161 profit on the trade, even with both adjustments. And so, if you look at the blue line, the blue line is sloping downwards. So look at the blue number right here. Now, right now, today, Berkshire is down 87 cents, which is about 1%. It was down more. It was down a dollar, a little bit over a dollar. And as you can see from the chart, you know, the last 4 days has been down. The market's been on down, so down the last 4 days. So if it continues to go down, if you look at the blue number right here, you'll see that as Berkshire goes down, if it goes down another dollar, let's say it goes from 80 to 79, let's say it goes down a dollar tomorrow, now we're only up $69.45. So we're giving up $100, almost $90. We're giving up $100 just to stay in the trade. Now on the flip side, if it goes from 80 to 81, we're making about $40. So there is a lot more risk on the downside than there is to the upside. And so that is one reason why I'm thinking that an adjustment might be in order. Another reason is that, you know, that's one reason why I'm thinking that I need to do something here. We could sit around and wait, but if you look at the red number, on the red number button there, if the stock stays at this price, we can make about $391 or $388 or $391. It keeps flipping, but you can make around $390. Right now we've already made $160, so we can make a little bit more, double our money, but then we'd have to be very, very careful that we stay all the way to expiration. Now, if the stock was somewhere around here at 81, which it was on Friday, then have no problem. You know, we could let it sit there another day and it wouldn't be a big deal. But since it has had this move down, another 1% down, and we're giving up a lot of our profit. And I don't want to do that. After sitting in the trade for 30 days, watching it, I don't want to give back my money. And the debit on this trade was the total cost of this trade was $836. And right now, as you can see here, we've made $161.88. So 161 divided by 836, which is our debit, equals 19.2%. So that is how much money we've made in the trade so far, 19.2%. Now, if we get out, we still have to pay commissions. I'm looking at here is if my commissions are $1.50, which is the rate that Option Genius members get at Thinkorswim. And so if you are paying $1.50 per option, you're looking at $48 in commissions. So 161 minus 48. After commissions, you make $113 divided by the debit of 836. You're still looking at a 13.5% return on this trade, even after commissions. So that's decent. I don't want to give that up. You know, and if the stock does move down tomorrow and we only make $60, well, I'm giving away $50 in commissions. So I don't want to do that. I won't make anything from all my work. So, and again, the calendar is a trade that you have to exit. It's not like a iron condor or a credit spread where you can let it expire. If you do let it expire, you're going to be losing money. So we do want to get out of this trade, and the best way to do that is just to exit. Now, if you'll notice here, we're short the April options, which is this month's expiration, and then we're long May and June options. So that is you can still stay in the trade if your 80s and 82.5s are going to expire. In this case, the only way that's going to happen is if the stock drops below 80 on expiration. The 82.5s might expire, but the 80s are right at the line. So you can stay in the trade, but for our purposes, we're going to exit here. Now, as an adjustment, what could we do if we decided, you know what, we're going to adjust? Well, the simplest adjustment to make would be to turn this back into a single calendar, and that would put 80 right at the middle. So what I would do is I would take off my 82.5 call calendar, just take that off, and to take it off, you would just enter an order to sell, and then our trade would look like this. So roughly we're at $161 so far we've made, and if you look at the red number on the right here, on the left here, sorry, the max you can make is $412. Now, that's if you stay into the trade at until expiration, and you're right here. You're sitting right at this number at 80, which is almost impossible to do. But even if you move around, you can still make $300 either direction, which is okay. But the thing is, I'm looking at the theta number here, and the theta tells you how much money you're going to make per day if the trade sits where it is, and you're only making $7 a day, which is not too much in my book. You're already up 161. To add another $7 to that, it's not gonna really help me out a lot. It doesn't even pay for lunch. So why am I gonna risk it? For try to stay in a couple more days to make another 14, 20, 30 bucks. I don't think that's really worth it. So that's kind of the thinking that I would look at, that if I want to go back and if I wanted to stay in the trade longer, for example, if I thought that Berkshire was going to continue downward and we had about 20 days left or even 15 days left or 20, 30 days left, then yeah, I'd probably take this off and convert it back into a single. And then maybe if it keeps going down and hits my break even on this side, then I could add another calendar here so that I could roll with the price. But been in the trade long enough, I don't see any reason to try to adjust. I got a decent sized profit, and so my answer is that I am going to go ahead and exit the trade here. The other option was to do nothing. And when would you do nothing? You would do nothing is if you did not think that Berkshire was going to go down any further. In order to do that, let's look at the chart and let's go to the day chart or the minute chart. And you can see there was a gap down this morning, hit a low of 79.6, and then basically it's been pretty unsteady the rest of the day, and I believe it's going to stay steady. Now, I cannot predict the future, so I can't tell what it's going to do tomorrow. Market did have a pretty big move down today, about 1%, a little bit over 1%, and Berkshire trades pretty much with the market. So if the market goes down tomorrow, Berkshire probably will go down as well. If the market goes up tomorrow, Berkshire can go up. But if the market goes up 1% and Berkshire goes up 1%, this trade will make another 40 bucks. So again, like we said, upside you can make 40 bucks, downside you lose 100 bucks. Which one would you take? That's up to you. I would probably just get out. So I'm going to take my money and run. My thinking here is pretty clear, and I'm going to take my 13.5% gain after commissions, and I'm going to go look for another trade. So that was the video. Double calendar, adjust or exit, or do nothing, I guess. If you have any questions, feel free to email us at optiongenius.com. This was one of our monthly trades that we put on for the Option Genius portfolio. As you can see, it did very well, 13.5% after commissions. And so these are the type of trades that we do. If you want more information about any of our trading plans or what kind of trades we do, you can visit us at optiongenius.com. And if you have any questions, feel free to email us. All right, have a good day and happy trading.